Imagine waking up to a world where gold and silver prices are flashing across every screen, surging to levels no one thought possible. The headlines are relentless. Currency collapse imminent, central banks in crisis, investors flee to safe havens. Social media is ablaze with panic and speculation. In the chaos, some people are celebrating life-changing gains, while others are paralyzed by uncertainty, watching the opportunity of a lifetime slip through their fingers. The air is thick with fear and greed, and the stakes have never been higher. This is the moment every precious metals investor dreams of and dreads. The question others sold too soon, haunted by the sight of prices doubling after they exited. The difference between these two outcomes isn't luck, it's preparation, discipline, and the ability to read the signals that most people ignore. Isn't just how high gold and silver can go, but whether you'll recognize the right time to sell before the window slams shut. History is littered with stories of those who held on too long, convinced the rally would never end, only to see their paper profits evaporate in a matter of days. This video is made for educational and informational purposes only, to help viewers better understand the topic. Most investors will freeze when it matters most. They'll wait for mainstream media to tell them what to do, not realizing that by the time the headlines scream all-time high, the smart money is already heading for the exits. The crowd will be distracted by noise, rumors, and emotional narratives, while a select few will quietly execute their exit strategies, locking in generational wealth. The real question is, which side of this divide will you be on? What you're about to discover isn't just another opinion or recycled advice. We're going to break down the critical signals, psychological traps, and actionable protocols that separate the winners from the also-rans. If you want to avoid the fate of those who missed the last great bull market, you need to understand what's coming next and how to act before it's too late. Don't get caught on the wrong side of history. What you learn in the next few minutes could mean the difference between securing your financial future or watching your gains evaporate. Subscribe, turn on notifications, and stay to the end for the actionable signals and protocols you won't find anywhere else. Throughout history, gold and silver have played a unique and irreplaceable role in the world's financial systems. When currencies falter, governments lose credibility, and trust in institutions evaporates, people instinctively turn to these precious metals. But why? What is it about gold and silver that makes them the ultimate safe havens when the monetary system begins to crack? To answer that, we need to look back at the very foundation of money itself. Long before paper currencies, digital wallets, or central banks, societies across continents and centuries converged on gold and silver as the ultimate forms of money. Their scarcity, durability, divisibility, and universal appeal made them the backbone of commerce and savings. Unlike fiat currencies, which can be created at the stroke of a pen or the click of a mouse, gold and silver require real effort to extract, refine, and store. This inherent limitation is what gives them their enduring value. When a monetary system is healthy, people rarely think about the underlying value of their currency. They trust that their dollars, euros, or yen will hold purchasing power tomorrow, next month, and next year. But when cracks begin to appear, when inflation surges, debts spiral, or central banks lose control, confidence evaporates almost overnight. Suddenly, the abstract promise of paper money feels fragile, even dangerous. In these moments, the psychology of flight to safety takes over. Investors, institutions, and ordinary savers all scramble for assets that can't be printed or devalued at will. Gold and silver shine brightest in these periods of uncertainty. They are not promises to pay, they are payment itself. When the world's reserve currencies have failed, whether it was the German mark in the 1920s, the Argentine peso in the early 2000s, or the Zimbabwean dollar in the 2000s, gold and silver have provided a lifeline. They become the ultimate insurance policy, a store of value that transcends borders, politics, and even war. But it's not just about history or tradition. The mechanics of how precious metals respond to currency debasement are rooted in simple supply and demand. When central banks flood the system with new money, the purchasing power of each unit declines. Savers and investors, seeking to protect their wealth, bid up the price of gold and silver. The more severe the crisis, the more intense the demand. This is why, during every major monetary breakdown, you see gold and silver prices spike, sometimes violently. There's also a psychological dimension that can't be ignored. In times of crisis, people crave something tangible, something real. Gold and silver are not just financial assets. They are symbols of stability and permanence. When trust in governments and banks collapses, the allure of holding a gold coin or a silver bar becomes almost primal. It's a way of opting out of a system that feels rigged or broken. Consider the 2008 financial crisis. As banks failed and stock markets crashed, gold prices soared. Investors who had dismissed precious metals as relics suddenly found themselves scrambling to buy. The same pattern repeated during the COVID-19 pandemic, when unprecedented money printing and economic uncertainty drove gold to new highs. Each time, Those who already held gold and silver were insulated from the worst effects of the crisis, while latecomers paid a premium to join the rush. But the story doesn't end there. Gold and silver also serve as a check on government power. When citizens and investors have the option to move their wealth into precious metals, it limits the ability of authorities to inflate away savings or impose draconian controls. This is why, throughout history, governments facing monetary crises have often tried to restrict or even confiscate gold. They understand its power as an escape valve, a way for people to protect themselves from reckless policies. It's important to recognize that gold and silver are not perfect. They don't pay interest, and their prices can be volatile in the short term. But in the context of a broken monetary system, their advantages become overwhelming. They are liquid, universally recognized, and immune to the whims of central bankers. When everything else is in doubt, gold and silver offer certainty. This is why, in every major crisis, you see the same pattern repeat. As confidence in paper money erodes, demand for precious metals explodes, prices rise, sometimes exponentially, as more and more people try to secure a piece of the safety net. Those who act early are rewarded with protection and profit. Those who wait until the panic is in full swing often find themselves paying top dollar, or worse, unable to buy at all. The lesson is clear. Gold and silver are not just investments. They are insurance against the failure of the system itself. They are the assets of last resort, the ultimate fallback when everything else is in question. Understanding their role is the first step in preparing for what comes next. As we move deeper into this exploration, keep in mind that the real value of gold and silver isn't just in their price, but in their ability to preserve purchasing power when nothing else will. In the next section, we'll break down the anatomy of a monetary breakdown and show you exactly how and why these crises unfold, so you can recognize the signals before the crowd and position yourself ahead of the next great rush. A monetary breakdown is rarely a single sudden event. It's a process, a series of escalating failures that erode trust, disrupt daily life, and ultimately force people to rethink what money really means. Understanding the anatomy of this process is crucial because it's in these moments of unraveling that gold and silver reveal their true value. Let's break down the warning signs and stages, using real-world examples to show how precious metals behave and how unprepared investors can be caught off guard. The first stage is subtle, a gradual loss of confidence. It often begins with persistent inflation, government deficits, or mounting external debts. At first, the public shrugs off these issues as temporary or manageable. But as prices rise and the cost of living outpaces wages, anxiety starts to build. In Weimar Germany after World War I, the government printed money to pay reparations and debts, leading to creeping inflation. At first, people believed it was a necessary evil, but as the mark lost value, trust in the currency began to erode. In Argentina, decades of fiscal mismanagement and currency devaluations have created a culture of skepticism, where citizens instinctively convert pesos to dollars or gold at the first sign of trouble. As confidence slips, the second stage emerges: capital controls and restrictions. Governments, desperate to stem the outflow of money and stabilize their currencies, impose limits on withdrawals, foreign exchange, and cross-border transfers. In Turkey, as the lira collapsed in recent years, authorities restricted access to foreign currency and gold, hoping to prevent a full-blown run on the banks. In Zimbabwe, during the hyperinflation of the 2000s, the government banned the use of foreign currencies and tried to force people to use the rapidly depreciating Zimbabwean dollar. These measures rarely restore confidence. Instead, they signal to the public that the situation is worse than advertised. The third stage is where panic sets in: hyperinflation and policy chaos. Prices begin to rise at an accelerating pace, sometimes doubling or tripling in a matter of weeks. The government responds with increasingly desperate measures: price controls, rationing, new currency issues, and even outright confiscation of assets. In Weimar Germany, the price of a loaf of bread went from a few marks to billions in less than 2 years. People were paid twice a day and rushed to spend their wages before they became worthless. In Zimbabwe, inflation reached an unfathomable 79.6 billion% in November 2008. Shops ran out of goods, and bartering became the norm. In Argentina, the government has repeatedly tried to freeze prices and control capital, only to see black markets flourish and inflation spiral out of control. Throughout these stages, gold and silver behave in ways that are both predictable and revealing. In the early phase of confidence loss, precious metals often move quietly as savvy investors begin to accumulate. Prices may rise gradually, but the real action happens behind the scenes. As capital controls are imposed, demand for gold and silver accelerates. Premiums over spot prices widen, and physical metal becomes harder to find. In Turkey, as the lira fell, gold shops saw lines out the door and premiums soared as people scrambled to convert their savings. In Argentina, gold jewelry and coins are prized as a way to store value and move wealth discreetly. When hyperinflation hits, gold and silver prices explode, not just in nominal terms, but in real purchasing power. In Weimar Germany, those who held gold were able to buy entire city blocks for a handful of coins. In Zimbabwe, gold became the de facto currency, with people trading small flakes for food and fuel. In Argentina, families who had converted pesos to gold or dollars were able to weather the storm, while those who trusted the system saw their savings wiped out. But there are traps along the way, pitfalls that catch even experienced investors. The first is complacency. Many people assume that because a crisis is slow to develop, they'll have time to react. In reality, the window to act can close suddenly. Capital controls can be imposed overnight, and access to physical gold and silver can dry up in days. In Turkey, those who waited too long found themselves unable to buy gold at any price, as shops ran out of inventory and the government tightened restrictions. The second trap is overconfidence in paper claims. During crises, gold ETFs, futures contracts, and unallocated accounts may not deliver the protection investors expect. In 2013, during the Cyprus banking crisis, some investors discovered that their gold was nothing more than a paper promise, inaccessible when they needed it most. Physical possession becomes paramount in a true breakdown. The third trap is psychological, the tendency to freeze or follow the crowd. When panic sets in, emotions run high. Some investors sell their gold and silver too early, spooked by volatility or government threats. Others hold on too long, convinced that prices will rise forever, only to see a sudden reversal as the crisis abates or authorities regain control. In Weimar Germany, some who waited for even higher prices missed the opportunity to convert their gold into productive assets, while others who sold too soon lost out on generational wealth. Another common pitfall is ignoring the black market. In many crises, official prices for gold and silver are meaningless. Governments may fix prices or ban private ownership, but underground markets thrive. In Zimbabwe, gold panners and traders created a parallel economy, using gold as money while the official system collapsed. In Argentina, a thriving black market for dollars and gold operates alongside the formal financial system, providing a lifeline for those who refuse to trust the peso. The final stage of a monetary breakdown is the search for a new equilibrium. Eventually, the old currency is abandoned or reformed, and a new system emerges. Those who preserve their wealth in gold and silver are often able to buy assets at fire sale prices, while those who clung to the old system are left with nothing. In Weimar Germany, fortunes were made by those who converted gold into real estate and businesses after the hyperinflation ended. In Argentina, families who held gold or dollars were able to buy homes, cars, and land for a fraction of their previous value. The anatomy of a monetary breakdown is a roadmap, a series of signals and stages that repeat across time and geography. Loss of confidence, capital controls, hyperinflation, and policy panic are not just abstract concepts. They are lived realities for millions of people. Gold and silver are not just hedges. They are lifelines, offering protection and opportunity when the system fails. But recognizing the stages is only half the battle. The real challenge is knowing how to act, when to buy, when to hold, and most importantly, when to sell. In the next section, we'll dive into the signals, triggers, and traps of a precious metals bull run so you can position yourself ahead of the crowd and avoid the mistakes that have cost others dearly. The window of opportunity is narrow and the stakes are high. Understanding the anatomy of a monetary breakdown is your first step toward mastering the cycle and turning crisis into opportunity. Every precious metals bull market, especially during times of crisis, follows a recognizable pattern. Understanding these phases is essential for anyone hoping to maximize gains and avoid the devastating pitfalls that have trapped countless investors in the past. The journey from stealth accumulation to blow-off top is marked by shifting sentiment, technical signals, government actions, and media narratives, all of which can either guide or mislead you. Let's break down each phase, the signals to watch, and the traps to avoid. The first phase is stealth accumulation. This is when the smart money, insiders, contrarians, and those with a deep understanding of macro trends begin quietly building positions in gold and silver. Prices may be depressed or moving sideways, and mainstream coverage is minimal or even dismissive. During this phase, sentiment is often negative. Analysts declare that gold is dead money and silver is too volatile. Yet, beneath the surface, central banks, hedge funds, and sophisticated investors are quietly buying. Technical indicators like rising volume on up days, positive divergences, and steady accumulation by large players can be early clues. The public is largely unaware, and the narrative is dominated by optimism in equities or other assets. The second phase is public awareness. As the crisis deepens, whether it's inflation, currency devaluation, or geopolitical turmoil, gold and silver begin to attract attention. Prices start to rise more noticeably, and financial media begins to take note. Stories about central banks increasing gold reserves or high-profile investors making bullish calls start to appear. Retail investors, sensing a shift, begin to enter the market. Technical signals such as moving averages crossing, breakouts from long-term resistance, and surging open interest in futures markets confirm the trend. Government interventions may also become more visible. Talk of capital controls, restrictions on gold imports or exports, or changes in tax policy. These are all signals that the bull run is gaining momentum. The third phase is mania. This is when the crowd finally wakes up. Headlines scream about record highs, and everyone seems to have an opinion on gold and silver. Social media is flooded with stories of overnight fortunes and new products. Leveraged ETFs, gold-backed cryptocurrencies, and silver mining stocks proliferate. The narrative shifts from skepticism to euphoria. Technical indicators go parabolic. RSI and MACD readings hit extremes, and price action becomes increasingly volatile. Premiums on physical metals soar, and shortages become common. Government interventions intensify, with talk of windfall taxes, export bans, or even outright confiscation. The psychological trap here is FOMO, fear of missing out. Investors who ignored gold and silver for years now rush in, often at the worst possible time. The final phase is the blow-off top. This is the most dangerous stage, where prices reach unsustainable levels and volatility is extreme. Media coverage is wall-to-wall, and everyone from taxi drivers to celebrities is talking about gold and silver. Technical signals flash warnings, massive volume spikes, failed breakouts, and negative divergences. Sentiment is euphoric, but cracks begin to appear. Governments may take drastic action, imposing new regulations, freezing accounts, or launching coordinated interventions to restore confidence in fiat currencies. The trap here is greed. Many investors convince themselves that this time is different, ignoring the warning signs and holding on for ever higher prices. When the reversal comes, it is swift and brutal. Prices can collapse in days or weeks, wiping out years of gains for those who failed to act. Throughout these phases, several key signals can help you navigate the bull run. Market sentiment is a powerful indicator. When everyone is bearish and gold is ignored, it's often the best time to buy. When euphoria is everywhere and people are making wild predictions, it's time to be cautious. Technical indicators, moving averages, volume patterns, and momentum oscillators can provide objective confirmation of trend changes. Watch for divergences between price and momentum, as these often precede major reversals. Government interventions are another critical signal. When authorities begin to restrict access to gold and silver, impose taxes, or launch anti-hoarding campaigns, it's a sign that the bull run is entering a dangerous phase. These actions rarely stop the rally, but they do signal that the window for easy gains is closing. Media narratives also matter. When the mainstream press shifts from skepticism to breathless coverage, it's a warning that the market is overheating. But perhaps the most important factor is psychology. The biggest trap is believing that you can time the top perfectly. History shows that even the most experienced investors struggle to exit at the peak. The key is to have a plan, set targets, scale out of positions, and resist the urge to chase the last few percentage points. Another common trap is falling for mainstream myths. That gold and silver are always safe, that this time is different, or that governments will never intervene. These beliefs can lead to complacency and costly mistakes. It's also vital to recognize the role of leverage. In the mania phase, many investors turn to leveraged products, options, futures, or margin trading to amplify gains. While this can be profitable in a rising market, it is disastrous when the reversal comes. Leverage magnifies losses, and forced liquidations can accelerate price declines. The blow-off top is often marked by a cascade of margin calls and panic selling. Another psychological trap is anchoring, fixating on a specific price target or past high. Investors who watched gold hit $2,000 or silver reach $50 in previous cycles may refuse to sell until those levels are breached again, even if the fundamentals have changed. This rigidity can lead to missed opportunities and unnecessary losses. Finally, beware of the expert trap. During bull runs, a new crop of gurus and influencers emerges, offering bold predictions and secret strategies. While some may offer valuable insights, many are simply riding the wave, selling hope to the desperate and inexperienced. Trust data, history, and your own plan, not the latest viral video or newsletter. In summary, the gold and silver bull run is a journey through stealth accumulation, public awareness, mania, and blow-off top. Each phase has its own signals, triggers, and traps. By understanding the mechanics of the market, monitoring sentiment and technical indicators, and staying disciplined in the face of emotion and hype, you can navigate the cycle with confidence. The next section will dive into the most critical decision of all, how to time your exit in a chaotic market, so you can lock in gains and avoid the fate of those who held on too long. The difference between fortune and regret is often just a single, well-timed decision. Selling gold and silver at the right moment is both an art and a science, especially when the market is gripped by chaos. The temptation to hold on just a little longer is powerful, but history shows that the difference between life-changing gains and missed opportunity often comes down to a single well-timed decision. To master the exit, you need to recognize the signs of a market top, understand the mechanics of liquidity, and avoid the psychological traps that have ensnared even the most seasoned investors. The first step is to identify the signals that a bull market is reaching its peak. One of the most reliable indicators is a dramatic surge in public participation. When everyone from your neighbor to mainstream news anchors is talking about gold and silver, when social media is flooded with stories of overnight millionaires, and when new products and services spring up to cater to the frenzy, you're likely in the late stages of the cycle. Data from past bull markets shows that parabolic price moves, where prices accelerate rapidly over a short period, are often unsustainable. In 1980, gold soared from $200 to $850 in less than 2 years, only to crash back below $300 within months. The same pattern repeated in 2011 when silver spiked to nearly $50 before collapsing by more than half. Another key signal is the behavior of premiums and liquidity. In the final stages of a bull run, premiums on physical gold and silver often skyrocket as demand overwhelms supply. Dealers may run out of inventory, and the spread between spot and retail prices can widen dramatically. This is a warning sign that the market is overheating. At the same time, liquidity can dry up quickly. In a panic, buyers may disappear, and it can become difficult to sell large positions without moving the market. This is why disciplined investors begin scaling out of their positions as the mania builds, rather than trying to time the absolute top. Technical indicators can also provide valuable clues. Overbought readings on momentum oscillators like the Relative Strength Index, RSI, negative divergences between price and volume, and failed breakouts are all classic signs of exhaustion. When prices make new highs but volume fails to confirm, or when momentum indicators begin to roll over, it's time to be cautious. Chart patterns such as blow-off tops, sharp vertical moves followed by equally sharp reversals, are a hallmark of market peaks. But the most important factor is psychology. The never-sell mentality is seductive, especially among gold bugs who view precious metals as the ultimate insurance against systemic collapse. While it's true that gold and silver can provide long-term protection, the reality is that markets move in cycles. The disciplined capital allocator understands that the goal is not to hold forever, but to maximize returns and redeploy capital when the risk-reward balance shifts. This means having a plan in advance, setting target prices, scaling out in tranches, and resisting the urge to chase every last dollar. Real-world anecdotes illustrate the dangers of waiting too long. During the 1980 gold mania, many investors refused to sell, convinced that prices would keep rising indefinitely. When the reversal came, it was swift and brutal. Fortunes evaporated in weeks, and some who had been sitting on life-changing gains were left with little more than regret. In contrast, those who sold into strength, taking profits as prices went parabolic, were able to lock in their gains and redeploy capital into undervalued assets. Liquidity crunches are another critical consideration. In a true crisis, markets can become disorderly. Bid-ask spreads widen, and it can become difficult to find buyers at quoted prices. This is especially true for larger positions or less liquid forms of gold and silver, such as rare coins or large bars. The disciplined investor anticipates this by selling incrementally as the market heats up, rather than waiting for a single, perfect exit. Data and charts can help illustrate optimal exit strategies. For example, analysis of past bull markets shows that scaling out, selling a portion of your holdings at predetermined price targets, consistently outperforms trying to call the exact top. This approach reduces the risk of missing the window entirely and allows you to participate in further upside while locking in profits along the way. Setting trailing stop orders, where you automatically sell if the price falls by a certain percentage from its high, can also help protect gains without requiring constant monitoring. Contrast this with the all-or-nothing approach favored by some gold bugs. The belief that gold and silver should never be sold, no matter how high the price, is rooted in distrust of fiat currencies and a desire for absolute security. While this mindset can be valuable in the early stages of a crisis, it becomes a liability as the market matures. The disciplined allocator recognizes that every asset has its time, and that the goal is to preserve and grow wealth, not to cling to a single narrative. Government actions can also influence the timing of your exit. As prices soar and public anxiety mounts, authorities may impose new taxes, reporting requirements, or even restrictions on sales. In the 1930s, the U.S. government famously confiscated gold, forcing citizens to sell at fixed prices. More recently, countries facing currency crises have imposed capital controls or banned the export of precious metals. These interventions rarely come without warning. Rising political rhetoric, new legislation, and increased scrutiny of gold dealers are all red flags that the window for a clean exit may be closing. The final piece of the puzzle is emotional discipline. Selling into a rising market is psychologically difficult. The fear of missing out on further gains can be overwhelming, especially when friends, family, and the media are all celebrating new highs. But history is clear. The crowd is almost always wrong at the extremes. The disciplined investor tunes out the noise, follows their plan, and acts decisively when the signals align. In summary, timing the exit in a chaotic market requires a blend of technical analysis, market awareness, and emotional discipline. Watch for signs of mania, parabolic price moves, surging premiums, and frenzied media coverage. Use data and charts to set rational targets and scale out of positions as the market heats up. Be alert to liquidity crunches and government interventions, and don't let fear or greed dictate your decisions. The difference between fortune and regret is rarely luck. It's preparation, discipline, and the courage to act when others hesitate. In the next section, we'll bring these lessons to life with real-world case studies from past crises, showing exactly how investors navigated the chaos, made their sell decisions, and what happened to those who waited too long. The past is full of hard-earned wisdom if you know where to look. Every bull market in gold and silver eventually reaches a moment of truth, a point where fortunes are made or lost, not by those who simply held on, but by those who recognized the signals and acted decisively. The stories of past monetary breakdowns are filled with both triumph and heartbreak, and they offer a treasure trove of lessons for anyone navigating today's uncertain landscape. By examining the 1980 gold peak, the 2011 silver spike, and recent emerging market crises, we can extract the warning signs and actionable strategies that separate the winners from the also-rans. Let's begin with the legendary gold bull market of the late 1970s. The world was reeling from oil shocks, runaway inflation, and geopolitical turmoil. The US dollar, once anchored to gold, had been cut loose, and confidence in fiat money was evaporating. Gold, which had traded at $35 an ounce for decades, began a relentless climb. By early 1980, it had reached an astonishing $850 an ounce, a 24-fold increase in less than a decade. The headlines were breathless, and the public was in a frenzy. People lined up outside coin shops, desperate to buy at any price. The media was filled with stories of ordinary people becoming millionaires overnight. But beneath the euphoria, there were clear warning signs. Premiums on physical gold soared, and dealers struggled to keep up with demand. Technical indicators flashed red. The price of gold was rising vertically, far above its long-term moving averages, and momentum indicators were at historic extremes. The government, alarmed by the mania, began to talk openly about new regulations and interventions. Yet, many investors ignored these signals, convinced that the rally would never end. One famous story is that of a New York taxi driver who, after hearing endless tales of gold's unstoppable rise, sold his family's home to buy gold at the peak. Within months, the price had collapsed by more than half, and he was left with devastating losses. In contrast, some of the most successful investors of the era, like the legendary Paul Tudor Jones, began selling into strength as the mania peaked, locking in their gains and moving to the sidelines. Their discipline was not based on luck, but on a clear-eyed reading of the signals: parabolic price action, surging public participation, and government warnings. The 2011 silver spike offers another powerful lesson. In the aftermath of the global financial crisis, central banks unleashed unprecedented monetary stimulus. Fears of currency debasement and sovereign defaults sent precious metals soaring. Silver, which had languished below $10 an ounce for years, exploded to nearly $50 in just a few months. The media was awash with stories of silver bugs predicting $100, $200, even $500 an ounce. Social media forums were filled with tales of overnight riches, and new silver ETFs and leveraged products flooded the market. But once again, the warning signs were there for those willing to see. The price of silver was rising far faster than gold, a classic sign of late-stage speculation. Premiums on physical silver reached record highs, and dealers reported shortages. Technical indicators were flashing overbought signals, and volatility was off the charts. The CME Group, which operates the world's largest silver futures market, responded by raising margin requirements, making it more expensive for speculators to hold leveraged positions. This move triggered a cascade of forced selling, and within days, silver had plunged by more than 30%. Many retail investors, caught up in the mania, were wiped out. Those who had set exit targets, scaled out of positions, or paid attention to the mounting risks were able to protect their gains. Emerging market crises offer a different but equally instructive set of case studies. In Argentina, decades of currency devaluation and capital controls have created a culture of financial survivalism. During the 2001-2002 crisis, as the peso collapsed and banks froze withdrawals, those who had converted their savings into gold or dollars were able to weather the storm. One Buenos Aires family, sensing trouble as inflation accelerated and political rhetoric turned hostile, sold their gold holdings just as the black market premium peaked. They used the proceeds to buy real estate at fire sale prices, turning a defensive move into a generational opportunity. Others, convinced that the crisis would only deepen, held on too long and saw their gains eroded as the government stabilized the currency and gold premiums collapsed. Turkey's recent currency crisis provides another real-time example. As the lira plunged and inflation soared, demand for gold and silver exploded. Savvy investors who had accumulated precious metals during quieter times found themselves in a position of strength. One Istanbul jeweler recounted how, as the crisis intensified, he began selling his gold inventory in small increments, taking advantage of surging premiums and desperate buyers. He avoided the temptation to hold out for even higher prices, recognizing that liquidity could vanish overnight if the government imposed new controls. His disciplined approach allowed him to lock in profits and reinvest in undervalued assets as the dust settled. These stories reveal several common threads. First, the most successful investors are those who pay attention to both market signals and the broader context. They recognize that parabolic price moves, surging public participation, and government interventions are not signs of strength but warnings that the end game is near. Second, they have a plan. Rather than trying to time the exact top, they set exit targets, scale out of positions, and remain flexible in the face of changing conditions. Third, they understand the importance of liquidity. In a true crisis, the ability to sell quickly and at a fair price is more valuable than squeezing out the last few percentage points of profit. There are also cautionary tales. In Zimbabwe, during the hyperinflation of the 2000s, many people hoarded gold as the local currency collapsed. But when the government imposed new restrictions and the black market dried up, some were unable to sell at any price. Others, who had converted their gold into hard assets or foreign currency before the crackdown, were able to preserve their wealth. The lesson is clear. The window for a clean exit can close suddenly and without warning. Another trap is the allure of "this time is different." In every bull market, there are voices claiming that the old rules no longer apply, that gold and silver will rise forever, that governments are powerless, or that a new paradigm has arrived. These narratives are seductive, but they are almost always wrong. The disciplined investor respects history, recognizes the signs of excess, and acts before the crowd. So, what are the actionable lessons for today's investors? First, monitor sentiment and participation. When everyone is talking about gold and silver, when new products and services proliferate, and when the media is breathless, it's time to be cautious. Second, watch for technical signals. Parabolic moves, overbought indicators, and failed breakouts are all red flags. Third, pay attention to government actions. New taxes, reporting requirements, or restrictions on sales are often the final warning that the window is closing. Fourth, have a plan. Set exit targets in advance, scale out of positions as the market heats up, and don't be afraid to take profits. Remember that the goal is not to sell at the absolute top, but to lock in gains and preserve capital. Fifth, prioritize liquidity. In a crisis, the ability to sell quickly is more important than maximizing every last dollar. Finally, stay humble. The market is bigger than any one investor, and the crowd is almost always wrong at the extremes. The stories of past crises are not just history, they are a roadmap for the future. By learning from those who navigated the chaos with discipline and foresight, you can position yourself to thrive when the next moment of truth arrives. In the next section, we'll explore what happens after you sell, how to protect your gains, avoid new risks, and seize the opportunities that emerge in the aftermath of a monetary breakdown. The end of a bull market is not the end of the story, it's the beginning of a new chapter for those who are prepared. The moment you sell your gold and silver, you cross a threshold. The adrenaline of the bull market fades, replaced by a new set of questions. What do you do with your proceeds? How do you protect your gains from new risks? And, perhaps most importantly, how do you turn a defensive victory into a springboard for future wealth? The aftermath of a monetary crisis is a landscape of both danger and opportunity, and the choices you make in this phase will determine whether your hard-won gains endure or evaporate. First, let's address the most common mistake, simply cashing out and sitting in fiat currency. After a crisis, it's tempting to convert your gold and silver into whatever currency is most stable at the moment, dollars, euros, or perhaps a newly reformed local currency. But history shows that this is rarely the optimal move. In the wake of a monetary breakdown, currencies are often volatile, subject to sudden devaluations, capital controls, or even outright replacement. The purchasing power you thought you'd secured can erode quickly if you're not vigilant. Contrast this with those who reinvest strategically. The most successful investors from past crises understood that the end of a gold or silver bull market is not the end of the story. It's the beginning of a new cycle. As panic subsides and stability returns, assets that were shunned during the crisis, real estate, productive businesses, even select equities, often become available at fire sale prices. Those who rotate their capital into these undervalued opportunities can multiply their wealth, while those who cling to cash risk missing the next wave. Asset rotation is a powerful tool in the post-crisis playbook. In Weimar Germany, those who sold gold at the peak and bought real estate or productive farmland were able to preserve and grow their wealth as the new monetary order took shape. In Argentina, families who used their gold proceeds to acquire property or invest in export-oriented businesses not only survived the crisis, but emerged stronger. The key is to identify assets that are essential, undervalued, and likely to benefit from the recovery. Real estate, especially in prime locations, often fits this bill. So do shares in companies that produce real goods and services, food, energy, infrastructure, rather than speculative financial plays. But asset rotation is not without risks. The post-crisis environment is often chaotic, with new regulations, shifting tax policies, and lingering political uncertainty. It's essential to conduct thorough due diligence, diversify your holdings, and remain flexible. Don't rush to deploy all your capital at once. Instead, look for clear signs of stabilization, rising transaction volumes, improving business sentiment, and the return of long-term investors. Be wary of assets that have rebounded too quickly or are being hyped as the next big thing. The best opportunities are often found in areas that are still overlooked or undervalued. Another critical consideration is the risk of confiscation or punitive taxation. Governments emerging from crisis are often desperate for revenue and may target those perceived as having profited from the turmoil. This is why privacy, discretion, and legal compliance are paramount. Work with trusted advisors to structure your holdings in a way that minimizes exposure to arbitrary confiscation or excessive taxation. In some cases, this may mean diversifying internationally, holding assets in multiple jurisdictions to reduce political risk. The emergence of new monetary regimes is another factor to watch. After a crisis, governments may introduce new currencies, peg to foreign benchmarks, or even experiment with digital money. Each scenario presents both risks and opportunities. A new currency may offer a window to convert your proceeds at a favorable rate, but it can also be a trap if the government imposes conversion limits or unfavorable terms. Digital currencies, whether state-backed or decentralized, may offer new avenues for capital preservation and mobility, but they also come with regulatory and technological risks. Productive assets, businesses, farmland, intellectual property often offer the best long-term protection and growth. Unlike cash or even gold, these assets generate income and can adapt to changing conditions. In the aftermath of a crisis, demand for essentials, food, energy, housing, tends to rebound quickly. Investing in businesses that meet these needs can provide both security and upside. Look for opportunities to partner with experienced operators, acquire distressed assets, or launch new ventures that address emerging gaps in the market. It's also important to manage your liquidity. While it's tempting to go all in on a single asset class, maintaining a portion of your wealth in liquid, easily transferable forms gives you the flexibility to respond to new opportunities or threats. This might mean holding a mix of cash, short-term bonds, or even a small reserve of gold and silver as a hedge against renewed instability. The psychological transition from defense to offense is not always easy. After months or years of crisis, it's natural to be cautious, even fearful. But history rewards those who can shift their mindset, who recognize that the greatest fortunes are often made in the aftermath of turmoil, not during the panic itself. The key is to stay informed, remain adaptable, and act with both courage and discipline. Let's contrast two archetypes, the cautious casher and the strategic reinvestor. The cautious casher sells gold and silver at the peak, converts everything to cash, and waits for the dust to settle. They avoid immediate losses, but often miss the best opportunities as inflation, devaluation, or new taxes erode their purchasing power. The strategic reinvestor, on the other hand, uses a portion of their proceeds to acquire undervalued assets, diversify internationally, and position for the next cycle. They accept some risk, but are rewarded with outsized gains as the economy recovers. The post-crisis landscape is also a time for reflection and learning. Review your decisions, analyze what worked and what didn't, and update your protocols for the future. The world is always changing, and the next crisis may look very different from the last. By staying humble, curious, and proactive, you can turn each cycle into a stepping stone for greater resilience and prosperity. Finally, remember that wealth is not just about numbers on a screen or bars in a vault. It's about security, freedom, and the ability to shape your own destiny. The decisions you make after selling your gold and silver will determine not just your financial future, but your ability to thrive in a world that is constantly reinventing itself. In the next section, we'll lay out a practical step-by-step exit playbook, so you can move from theory to action and ensure that your hard-earned gains are protected, multiplied, and ready for whatever comes next. The end of the bull market is just the beginning of your next opportunity. Turning hard-earned gains into lasting wealth requires more than just intuition or luck. It demands a disciplined, actionable protocol. The following playbook is designed to guide you through every step of the exit process, from monitoring signals to executing sales and reallocating capital. By following these steps, you can avoid costly mistakes, lock in profits, and position yourself for the next phase of opportunity. Step 1. Monitor the right signals. Begin by establishing a system for tracking the key indicators that precede market tops. This includes both quantitative and qualitative data. Watch for parabolic price moves, surging premiums on physical metals, and extreme readings on technical indicators like RSI and MACD. Monitor sentiment through news headlines, social media chatter, and the proliferation of new gold and silver products. Pay close attention to government actions. New taxes, reporting requirements, or restrictions on sales are often late-stage warning signs. Use trusted data sources such as Kitco, Bloomberg, and the World Gold Council for real-time price and market updates. Step 2. Set clear exit targets. Before the mania phase hits, define your exit strategy. Set specific price targets for selling portions of your holdings based on historical resistance levels, technical analysis, and your personal financial goals. Consider scaling out in tranches, selling a percentage at each target rather than trying to time the absolute top. This approach reduces regret and ensures you capture gains even if the market reverses suddenly. Write down your targets and review them regularly as conditions evolve. Step 3. Prepare for tax implications. Consult with a tax professional to understand the implications of your sales. Different jurisdictions treat capital gains on precious metals in various ways, and failing to plan ahead can result in unexpected liabilities. Keep meticulous records of your purchase dates, amounts, and sale prices. Explore tax-advantaged accounts or structures if available, and consider the timing of your sales to optimize your tax position. Remember, a well-executed exit is not just about price. It's about what you keep after taxes. Step 4. Choose trusted platforms and methods. Decide in advance where and how you will sell your metals. For physical gold and silver, identify reputable dealers, online platforms, or local buyers with a track record of fair pricing and secure transactions. For larger transactions, consider using a bullion bank or a specialized broker. If you hold metals in allocated storage, ensure you understand the process for withdrawal and sale. For ETFs or digital gold, know the procedures for liquidation and fund transfer. Avoid last-minute decisions that could expose you to fraud or unfavorable terms. Step 5. Execute sales safely and securely. When your signals and targets align, act decisively. Contact your chosen dealer or platform, confirm current premiums and buyback policies, and arrange for secure delivery or transfer. For in-person sales, prioritize safety, meet in secure locations, verify credentials, and use escrow services if necessary. For online transactions, use platforms with robust security protocols and insurance coverage. Double-check all details before finalizing the sale, and retain documentation for your records. Step 6. Reallocate capital strategically. Once your sales are complete, move quickly to protect and grow your proceeds. Review your asset allocation and consider rotating into undervalued opportunities, real estate, productive businesses, or select equities. Diversify across asset classes and geographies to reduce risk. Maintain a portion of your wealth in liquid, easily accessible forms to preserve flexibility. Use decision trees to evaluate new investments. Is the asset essential? Is it undervalued? Does it generate income or provide utility in a post-crisis world? Step 7. Maintain contingency plans. No plan survives first contact with reality, so build in flexibility. If the market reverses before you reach your targets, be prepared to adjust your strategy. If government interventions make sales difficult, have alternative channels ready, such as peer-to-peer networks or international platforms. If premiums spike or liquidity dries up, consider selling in smaller increments or using different forms of metal. Regularly review and update your plan as conditions change. Step 8. Use checklists and decision trees. Create a personalized checklist to guide your actions at each stage. For example, are price targets being met? Have you identified reinvestment opportunities? Is your chosen platform ready and secure? Have you identified reinvestment opportunities? Use decision trees to map out your options. If prices hit target A, sell X%. If government announces new restrictions, accelerate sales. If liquidity dries up, switch to alternative buyers. This structured approach reduces emotional decision-making and ensures you stay on track. Step 9. Leverage tools and data sources. Stay informed with real-time data and analysis. Use price alert apps, market dashboards, and news aggregators to monitor developments. Subscribe to reputable newsletters and follow analysts with a track record of accuracy. Use portfolio management tools to track your holdings, sales, and reinvestments. The more informed you are, the more confidently you can act. Step 10. Review and refine your protocol. After executing your exit, take time to review the process. What worked well? What could be improved? Update your playbook with new insights and lessons learned. The goal is continuous improvement. Each cycle should make you more resilient, disciplined, and prepared for the next opportunity. In summary, a successful gold and silver exit is not a single event, but a disciplined process. By monitoring signals, setting clear targets, managing taxes, choosing trusted platforms, and reallocating capital strategically, you can turn market chaos into lasting wealth. Use checklists, decision trees, and real-time data to stay ahead of the curve, and always maintain contingency plans for the unexpected. The market rewards those who are prepared, decisive, and adaptable. With this playbook in hand, you're ready to navigate the exit with confidence and turn your gains into a foundation for future prosperity. History is a master teacher, and nowhere is this more evident than in the stories of past currency regime changes. Each transition, whether sudden or gradual, has left a trail of winners and losers, and the lessons are as relevant today as ever. By examining the collapse of Bretton Woods, the birth of the euro, and other pivotal shifts, we can draw powerful parallels and extract actionable insights for investors facing the uncertainty of a changing monetary landscape. The collapse of the Bretton Woods system in the early 1970s is a classic case. For decades, the world's currencies were pegged to the US dollar, which itself was convertible to gold at $35 an ounce. This arrangement fostered stability, but by the late 1960s, mounting US deficits and inflationary pressures made the peg unsustainable. In 1971, President Nixon shocked the world by suspending dollar convertibility to gold, effectively ending the Bretton Woods era. The immediate aftermath was chaos. Currencies floated, exchange rates gyrated, and gold soared from $35 to over $800 in less than a decade. Investors who recognized the signs, rising U.S. deficits, gold outflows, and mounting international pressure, were able to position themselves ahead of the curve. Those who clung to the old paradigm, trusting that the dollar's supremacy would endure, saw their purchasing power erode. The lesson? Monetary regimes can and do change, often faster than most expect. Flexibility, vigilance, and a willingness to act on emerging signals are essential. The rise of the euro in the late 1990s and early 2000s offers another instructive example. The creation of a single European currency was a monumental experiment, uniting diverse economies under one monetary policy. For years, skeptics doubted it would succeed, while optimists predicted a new era of stability. The transition was anything but smooth. National currencies were phased out, and the euro's value fluctuated wildly in its early years. Some countries, like Germany, benefited from lower interest rates and export growth. Others, like Greece and Italy, struggled with debt and competitiveness. Investors who anticipated the euro's impact on trade, capital flows, and asset prices were able to profit from the transition. Those who ignored the risks, such as the loss of monetary sovereignty or the potential for crisis in weaker economies, were caught off guard during the eurozone debt crisis a decade later. The lesson? Regime changes create both opportunities and new vulnerabilities. Understanding the underlying dynamics is critical to navigating the transition. Other examples abound. In the 1990s, the collapse of the Soviet Union triggered a wave of currency chaos across Eastern Europe and Central Asia. Old rubles became worthless overnight, and new national currencies emerged. Those who held hard assets, gold, real estate, or foreign currency, were able to preserve their wealth. Those who trusted the old system saw their savings wiped out. In Zimbabwe, hyperinflation in the 2000s rendered the local dollar useless, and gold, US dollars, and even barter became the de facto means of exchange. The nimblest actors, those who moved quickly to alternative stores of value, survived and even thrived. Even the transition to digital money in recent years offers lessons. The rise of cryptocurrencies has challenged traditional notions of money and forced central banks to rethink their strategies. Early adopters who understood the potential of blockchain technology and decentralized finance were able to capture outsized gains. Those who dismissed these innovations as fads missed a generational shift in how value is stored and transferred. What unites all these stories is the power of adaptability. The investors who prospered were not necessarily the smartest or the most connected. They were the most prepared to recognize change, question old assumptions, and act decisively. They diversified their holdings, stayed informed, and maintained the flexibility to pivot as new realities emerged. For today's investors, the parallels are clear. The global monetary system is once again under strain, with rising debt, geopolitical tensions, and technological disruption challenging the status quo. The next regime change may not look exactly like those of the past, but the principles remain the same. Stay alert to the warning signs, policy shifts, capital controls, and changes in market sentiment. Diversify across assets, currencies, and geographies. And above all, be ready to act when the signals align. History does not repeat, but it often rhymes. By studying the lessons of past currency shifts, you can position yourself not just to survive, but to seize the opportunities that always accompany great change. The winners of tomorrow will be those who learn from the past, prepare for the future, and act with clarity when the moment arrives. As we've seen, the journey through a monetary crisis is fraught with both peril and opportunity. Gold and silver have always been the ultimate safe havens when trust in the system falters, but the real challenge isn't just knowing when to buy, It's having the discipline and foresight to sell when the time is right. The stories of past crises, from the collapse of Bretton Woods to the wild swings of the 1980 gold peak and the 2011 silver spike, all point to a single truth: the window to lock in your gains is narrow, and it rarely stays open for long. The most successful investors are those who prepare in advance, monitor the right signals, and act decisively before the crowd. They understand that markets move in cycles, that euphoria is a warning sign, and that government interventions can close the exit door without warning. They don't let fear or greed dictate their decisions. They follow a plan, scale out of positions, and rotate into new opportunities as the landscape shifts. If there's one lesson to take away, it's this: fortune favors the prepared. The next monetary crisis may look different from those of the past, but the principles remain the same. Stay vigilant, stay flexible, and don't wait for the headlines to tell you what to do. By the time the mainstream catches on, the best opportunities will already be gone. Now it's your turn. What's your strategy for timing the gold and silver exit? Have you set your targets, or are you still waiting for the perfect signal? Share your thoughts and experiences in the comments below. And if you found this guide valuable, don't forget to subscribe and turn on notifications, so you never miss the insights that could make all the difference for your financial future. The window won't stay open forever. Make sure you're ready when your moment comes.